Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh with us. It's Friday. We're wrapping up the week, and it's been a week, Jim. We've had the stock market insatiably grind higher this week, all week.
Yeah. Well, again, has been my expectation, is that we were seeing a low put in a couple of weeks ago, and that market was oversold, and I felt that we were likely to see the banking crisis ease up. And then one of the charts I showed last week was the expectation that KRE, the regional bank ETF, would drop to a new low and then complete 5 down, which then meant it was going to rally for a period of time. And that once that began to happen, it would give everybody else confidence that, oh, wait, this isn't getting worse. And then we did see the data out of the Fed yesterday, where borrowings at the discount windows and so forth, they haven't dropped a lot, but they aren't going up. So all the symptoms that, okay, this pressure point is starting to ease. And again, the Atlanta Fed, I think their GDP now for the first quarter is 3.2%. That's probably overstating the actual strength by a little bit. But I think, again, and we're going to talk about this in a second, because of the banking crisis, oh my God, the sky is falling type of thing. And to me, there's 2 steps. One is easing the liquidity squeeze, which the Fed has done effectively. So things have stabilized. The second part isn't going to manifest itself for months. And that is the big contraction in lending that's going to hit small and medium-sized businesses, because the small banks, I think, generate 36 or 38% of all lending, 67% of real estate lending, and there's $1 trillion worth of real estate loans that are going to have to be rolled over. So to me, that's the delayed reaction that is not coming, but yet markets kind of perceived, oh my God, it's all going to happen right away. And I think that's going to be the hook. And we're going to look at a chart of the 2-year Treasury yield, because it kind of reflects what I would call the optimistic, psychotic nature of Wall Street over the last 6-9 months. Because we saw the 2-year drop to, I think, to 405, something like that, on February 2nd. It was after the Fed raised rates on February 1st. Then rocket up to 507, I think. Why don't you pull that chart up? Because I'm working on memory banks that are not. Let me see
if I can pull that up in the near term while you're talking.
Yeah. So after dropping down on February 2nd down to about 405, I think it rallied up to 506, 507, March 7th, or whenever it was, and then plunge to 455 a week or so ago, and then it's rebounded to touch, but it just shows. No, how about the one I sent you? Or you don't have
that? I've got that one too, Jim. Hold on 1 second.
It's Friday morning.
I'll get that one
it's
for
been
you.
A long week, and it feels like it should be Saturday morning, right?
Yeah, right.
Best laid plans, right? But my point is the gyrations in the 2-year really reflect the manic reactions of Wall Street in terms of what they expect out of the Fed. So, we saw this big plunge in the 2-year. And yeah, here's the numbers. Got 4% down in February 2nd, up to 507 a month later. Then a little bit later, 355. I think that should be like 313. So I've had the date wrong. And then back up to 411 yesterday, or today, this morning, I should say. So that big plunge implies that, oh my God, the Fed's going to stop raising rates. And already they're pricing in at least 2 rate cuts starting in June. All right. So there's this perception in the markets that, oh my God, this is going to force the Fed not only to stop raising rates, but immediately reverse and start cutting rates. And my point is, once you solve the liquidity problem that the regional bank crisis represented, which appears to have taken place, it ignores what's coming down the road a little bit. And the next chart shows corporate bond market distress level. So what you can see is during the financial crisis, 2008 and 9, how much this distress index rallied from 2007 up. In 2011, you had the European bank crisis, where Mario said, whatever it takes.
Whatever it takes, yes.
Yep. 2016 was when oil prices plunged and a lot of energy bonds were really very under stress. You can see 2019 where the Fed was starting to raise rates, and then at the end when they shifted, came back down, obviously the pandemic. And then late last year, because as we've talked, by the middle of last year, people, we're already in a recession, or we surely will be by year end. And so you saw this stress index really tick up. So there's a disconnect going on here. On one hand, oh my God, the Fed's going to have to cut rates. And then, but yet the corporate bond market, in terms of looking at high yields, they're kind of saying, no, the economy's fine. So that to me is the disconnect that I think is going to play out in the next couple of months, is as we see bank lending standards go higher. And it's funny, all of a sudden, the last 2 weeks, a lot of people are talking about bank lending standards. I think you and I have been talking about it for 3-4 months, looking at the senior loan officer survey. So that's what's coming. And then lending by the regional banks is going to get curtailed significantly. That's going to cause more stress in the economy. But that's all going to take time. And so my point is, people are overreacting if you look at the 2-year in terms of what that's going to mean for the Fed. And yet here we look at the corporate distress, and it's like, there's hardly any distress. That will go up when people really perceive that, oh, wait a second, we are actually maybe not going to have no landing. We're actually going to go for a recession. So
and then you'll see these indicators move higher again.
Exactly. So to me, that's the disconnect. That I think, again, is wrong. I just think that the economy is, in the near term, is going to continue to be okay. Unemployment really low, wage growth is still strong, consumers still have savings. And so when you're in the middle of the financial markets, it's easy to kind of project that, oh my God, this is going to have a big impact on the economy. But as I've noted the last 2 weeks, the average consumer is oblivious to most of this stuff. They're going to work, they're raising their family, they're going to, sporting events, and life is just going on. They're watching March Madness. And so to me, it doesn't translate into immediately, the average person saying, gee, there's something going on with those regional banks. I think I'll cut back on spending. So my point is, the economy still has forward momentum. And I think that's another reason why the market has been holding up, is because, and it surprised people, oh my God, doesn't the market know what's going on with regional banks? Part of it is, again, what we're seeing in the high yield market, and also the idea of, hey, the economy is still growing okay. Earnings are likely for the first quarter to be okay. Some sectors obviously are going to be weaker than others. So this is, I think, what the market's going to have to deal with over the next month or so, is sooner or later, we are going to see the impact from the regional banking crisis really slow bank lending, both in terms of credit cards for consumers, auto loans, because they're in all those markets. So it's just going to take time, Blake. But in the near term, to me, that was the bullish narrative for the S&P to continue to work its way higher.
Now, I know you've talked about the S&P maybe making a move to 4,300. We'll get to your charts here in a second, but the next chart you did bring up was just
KRE.
The KRE.
Yeah.
So what did you want to say about this? Because I look at this, and this is very bearish price action. I mean, yes, it's stabilized, but it's not recovering. It's still, to me, it's still flashing warning signs. What is this telling you?
Okay, I don't disagree with you. I mean, as I'm saying, basically, we're going to see small banks cut back on lending. Well, that's a profit center. They're also going to have to raise their deposit rates. The average deposit rate, according to the FDIC, is 0.37%.
Well, that's no wonder everybody's pulling their money out.
Right. So my point is, you had this crisis liquidation of assets out. I think it's just going to be a slow burn in coming months, where more and more people, you mean I can get 4.5%? Oh my God, let me go get it. But the chart patterns suggested, you can see the 1, 2, the low 2.5 weeks ago was wave 3. And that's why I thought we were going to see the KRE drop below 41.92. So that stuff in blue is from last week. So, hey, we're going to drop below 41.92 and then rally. and we saw the initial bounce. I think that was wave A from 41.28 up to 45-ish, I think it got up to. Then this little sideways thing. I think there's probably another pop-up that will get it above 46, into that range of 46, 49. But as you're drawing on that chart, I think after this bounce is over, the likelihood is we're going to see more weakness come in as the economic reality, and the impact on earnings that the small banks are going to experience is going to weigh on prices. So,
Jim,
but
go.
Yes.
I'm sorry, I didn't mean to interrupt.
No, the only thing I was going to say is once we made that low, we had that wave 5 down. That's why I said, okay, once this is over, we're going to see KRE rally, which is going to enable the overall market then to stop worrying and then rally. And that's pretty much what's played out.
So how would your count change if let's say you're wrong, and we are just sitting here in this consolidation, and all of a sudden we just slip to new lows and we start trading below 40? What would be your count then? If that happened?
I'm expecting that to happen. It just comes down to, are we going to get a little bit more of a bounce before that happens? And if we get a little bit more of a bounce, that maybe gives the market some legs very, very near term. So my point is, if you see that happen, I think the market's in trouble.
Okay. All right. And then that takes us to our next chart, which is your S&P, because you've been, targeting higher levels in the S&P, a recovery. We're getting it as we speak. We're near the highs of the day, coming at the end of the week. If there's no blowups going into this weekend, maybe we might even make it a little higher, right?
Yeah, I mean, and part of it is end of month window dressing. Okay, so some of the stocks that have been doing well get bid up. So we're seeing, I think, technology benefit from that. But basically, to me, there's two patterns here. One, that, all right, we're going to rally above 41.95. In other words, you had that push up, we had this pullback, and to complete the rally from last October, you need the S&P to get above 41.95. All right, that's one pattern. The other pattern is the high's already in. The 41.95 was the end of the October rally. And you can see 1, 2, 3, 4, 5 down to 38.08 in the S&P. And then you see a pop up to 4,039, the pullback to 39.08. So I would call those A, B.
Oh, okay.
You have 4, I would make that A, and the 39.08 would be B. So the S&P rallied 131 points from 38.08. If I add 131 points to 39.08, what do I get? You get 231 points. You get the 41.39 or something like that, right? So to me, that's just saying, okay, you got a 1, 2, 3, 4, 5, you get an A, B, C up here, and then you're rolling over. So again, there's just this, I think, a short window of time over the next week or so where you got a little bit more upside coming, and then I think we roll over.
Okay, and which, I mean, this target of 41.30 to 41.50 might provide people that are looking to sell into strength a place to do so.
Definitely, and then use a trailing stop. The bottom panel, this is this oscillator that I use, 21-day net advanced declines. It was really oversold. That's one of the things I kept saying. Hey, we're still oversold. We got to go up a little bit more. You can see that red line is where it begins to become overbought. So we're getting up to that area. So that's my point is you've got the market working off the oversold condition, getting to the point where it's going to be overbought. And if it gets up to that 41.30 to 41.50, now you're at a price target that says that might be it, So definitely, to your point, that's a window of time, I think, for people to lighten up. But there is the chance that we could see 41.95, something above that.
All right.
But again, once this move is over, I think there's the risk of a fair amount of downside.
And you start going into the second half of 2023, and it looks kind of dangerous after that, right?
Going into mid-year, quite honestly, because I think we're going to see more pronounced slowing as we get deeper into the second quarter, and that's when reality hits for people. All right,
sell in May and go away might actually be a big thing this year.
That or April, get a jump start on that sell in May. Yeah. Okay, so TLT, my expectation was that TLT was going to drop below 103.75. I think it got to 103.60. And the idea was, buy it if it gets below 103.75, because potentially that high back in December was wave A of a much bigger A, B down to the 98.88. And then we've had one of C, the pullback here was two of C, and now we're about to pop. So again, this chart pattern implies that, again, there's a little bit more of a window of time where the S&P can rally before things really hit the fan. And that if that does happen, two legs equal. Well, it rallied from 91.85 to 109.16 or 68, pardon me. So that's, $18 almost. At $18 to 98.88, and you're up around the 115 to 117. And all it is a big A up, B down, and a C up. If that's going to happen, it's going to be because there's more flight to quality and or more signs that the economy really is weakening. I think in the near term, it's more likely to be, concerns about banks again.
Yeah. Okay. Well, that's fair enough. And if the bond market rallies, yields will come down, maybe rates will come down, help stabilize the market a little bit. I don't know. So
again, if it comes down because we got renewed problems with the regional banks, or there's more problems with banks in Europe and so forth, then all of a sudden lower yields are happening, not for a good reason.
Yeah.
And I think that's the risk. And the other thing, obviously, is I still believe that the risk of recession is really high. We've talked about this for months, leading economic indicators, inverted yield curve. That I've been pounding is like, hey, just as important as the increase in lending standards, guess what? They're going to get ramped up some more. And I just think people are just ignoring all those things. The problem is that there's a lag time with those long-term recession indicators. And what stretched that lag time even more in this cycle, Blake, is the buildup of savings that consumers had coming into this window of time. Job growth, unemployment low, wage growth, all those things are kind of pushing back or stretching the lag time. And I think making people think, hey, since it hasn't happened already, it ain't going to happen. And I just think that that's not the way it's going to play out.
Interesting. All right. Well, this is your chart on the dollar. The dollar is trying to find some footing today following the end of month, end of quarter. What are your thoughts here?
Still thinking that as long as it holds 101.90, it's going above 105.20. In other words, that first leg up looks like 5 up, got a 3-wave down into the low at 101.91, as it turned out. And then we popped, pulled back. I think it's going to go. I'm wrong if it gets below 101.90 on a closing basis. That's simple.
Okay. So it does. You think that we are forming a higher low, and where would your target be? Is obviously above 106.
Yeah, 106 to 108 range. And again, if the economy continues to be okay, and the credit, the regional bank crisis backs off a little bit, all of a sudden that means the Fed isn't going to be cutting rates in the second half of this year, as everybody has already kind of concluded that they will. So that's why the dollar could get some strength. If there's some banking problems in Europe, that would be another reason why the dollar would strengthen relative to the euro.
All right. Well, the last chart you have here is in gold. And I know, I mean, gold has been giving us this bullish consolidation here, and it's just looking good. But if the dollar is going to rally, is gold going to give it up? Is gold going to turn? I mean, is it possible that the gold and the dollar go up at the same time, Jim?
It's possible. But I think in the very near term, Blake, what you can see, the labeling I have on that chart is back in September, the gold completed a big ABC correction from August of 2020. Then we got 1, 2, 3, 4, 5. So could you get one more pop above that high, which was what, 2007, 2010? I can't remember precisely. Okay.
Yeah, it's like 2010 or 2009, depending on what you're looking at.
It could be like, this is wave 4 of wave 5, this choppiness. You get one more pop up, and then I think you see a correction. A minimum, I believe, is 1850, 1870. Wave 4 of lesser degree is, as you have it circled, right above 1800. So I think gold is near a high, and I think it's going to pull back.
Well, we were really inside of our community. We were looking at the price of silver, and silver's really up against a major triangle consolidation resistance today. And so I think if you are long precious metals, you should be listening to what Jim has to say. Matter of fact, Jim, I think every week people should be listening here to what you have to say. And if you do like what you hear from Jim, make sure you give him a thumbs up. Subscribe to Macro Tides. And how do I subscribe to Macro Tides, Jim?
Macrotides.com. And or if you want to see a recent publication, send me an email, jimwelshmacro@gmail.com, and you'll get a better idea of how I try to blend economic analysis, monetary analysis, and technical analysis to one. I don't think there's many people out there doing that kind of work. So I think people will find it interesting.
It's interesting, Jim, as you get as years go on, technical analysis is less and less wizardry as far as the market's concerned, and people really do respect it, and especially when you can marry the two together. So I want to thank you for marrying it together every single week here, and make sure you subscribe to this channel so you don't miss any of this exclusive content. Jim, I hope you have a really restful weekend.
Well, since I like to marry fundamental technical analysis, in the future you can call me Father Jim.
Oh, Father Jim, I love it. All right, Jim, have a great weekend, and we appreciate you.
All right, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.